Why can a decision in Tokyo raise borrowing costs in America? Most people think U.S. interest rates are only about the Federal Reserve. The Fed hikes, the Fed cuts, and everything else follows. But that is only part of the story, because global interest rates are not just about central banks. They are also about capital. Who has it? Where it goes? And what happens when it starts moving? That is where Japan comes in. Japan is often described as a slow, aging economy. But for global finance, Japan has been something much more important. For decades, Japan was one of the cheapest places in the world to borrow money. Rates stayed near zero, year after year. That created a powerful incentive for investors around the world. Borrow in yen, move the money overseas, buy assets that offer higher returns, U.S. Treasuries, corporate bonds, stocks, real estate, anything that paid more than Japan. This was not a small side trade. It became one of the hidden pipes of the global financial system. And the reason it mattered so much was scale. Japan had enormous savings, huge institutions, and massive pools of domestic capital looking for returns. So when money left Japan, it did not leave in tiny amounts. It moved in size. That helped support asset prices around the world. It helped support demand for bonds. And it helped create a world where Japan quietly supplied cheap funding to everyone else. That was the old system. And it worked as long as one assumption stayed alive. Japan would remain cheap forever. Now that assumption is starting to break. In March 2026, the Bank of Japan kept its policy rate at around 0.75%. To Americans, that may not sound dramatic. But in Japan, it changes the story. Because the issue is not whether 0.75% is high. The issue is that Japan is no longer guaranteed to stay near zero forever. And once investors begin to believe that, they start to recalculate everything. We already saw how sensitive markets can be. During the market turmoil in August 2024, Japan's Nikkei fell 12%. Korea's Kospi fell 9%, and the Nasdaq dropped 6% right after the open. That was a warning shot. The market was reacting to a dangerous possibility. What if Japan stops being the world's most reliable source of cheap money? And that leads to the second reason Japan matters so much. Japan is not only a funding country. Japan is also the largest foreign holder of U.S. Treasuries. As of January 2026, Japan held about $1.225 trillion of U.S. Treasury securities. That is more than the United Kingdom, and more than China. So when people ask who helps fund America's debt, Japan is one of the biggest answers. And that matters because U.S. interest rates are not shaped only by the Fed. They are also shaped by demand for U.S. government bonds. If a major buyer keeps buying, yields stay more contained. If a major buyer slows down or starts bringing money home, yields can rise. That does not require a panic. It does not require Japan to dump everything. It only requires direction to change. And that is the part many people miss. If Japanese yields become more attractive at home, some Japanese capital does not need to leave. Some of it can stay, some of it can come back. And when less money flows into U.S. Treasuries, America can feel it through higher yields. From there, the effects spread. Government borrowing becomes more expensive. Corporate financing gets tighter. Stock valuations come under pressure. And mortgage rates can move higher, too. That is why a policy shift in Tokyo can matter to families in the United States. Now add one more layer. Japan's own bond market is enormous. And most of it is still anchored inside Japan's domestic financial system. As of late 2025, the Bank of Japan held 43.1% of JGBs and T-bills. Banks held 16.3%. Insurance companies held 14.0%. Foreign investors held only 12.8%. That structure matters. It means Japan is not just a country that invests abroad. It is also a country with a giant domestic capital base that can be reallocated. And when a capital base that large starts to shift, global markets notice. So the real story is not simply that Japan owns a lot of US debt. The real story is that Japan sits at the center of a global capital flow, cheap money out, higher returns abroad, and now, potentially, some of that money turning back home. That is why Japan still matters. Not because it is loud, not because it dominates headlines, but because it helps shape the price of money. In Tokyo, in Washington, on Wall Street, and inside the US housing market. So the next time someone says Japan is a side story in global finance, remember this: Japan is one of the hidden forces behind global interest rates. And if Japan keeps moving, the rest of the world will have to adjust. Subscribe to Japan in Numbers.